The latest threat from Russia, saying that they will reduce 500,000 barrels a day their production due to the latest sanctions and latest restrictions from the European Union, is clearly not working. Oil prices remain very subdued, very little impact. One-day impact that is offset the day after. And it's fundamentally for a very simple reason. Russia is a large producer of oil. However, it only exports about 4.5 million barrels a day out of an 11 million barrel a day production. More importantly, in the supply and demand balance in the oil market right now, OPEC is important, but non-OPEC supply is what dictates the marginal barrel price. The fact that the United States is producing 11 million barrels a day, which is at best what Russia and Saudi Arabia can achieve individually, is clearly a very important factor. The reality is that non-OPEC supply is cushioning the impact of possible measures taken either by OPEC or by OPEC and Russia to limit supply in the market. And by the way, when they limit supply in the market, usually it is because there is ample supply already and because demand is either weak or not as strong as they expected. Finally, we have to remember rate hikes and the monetary phenomenon. Rate hikes make it a lot more difficult for traders to store oil and obviously finance the time in which that oil is stored either on sea or in warehouses. Rate hikes also make it much more difficult for traders to take elevated leverage positions on commodities. So you have two elements that are currently affecting oil markets. On the one hand, a very clear environment of a strong demand and limited supply, in which there is obviously a fundamentally bullish environment because of lack of investment in the past, particularly in the past decade. And on the other hand, you have the monetary phenomenon. And the monetary phenomenon is probably as important for the oil price as the second. So robust non-OPEC supply may cushion the blow or cushion the impact of measures taken by OPEC+. The scenario long-term remains bullish for the supply and demand picture because of lack of investment in the past decade, but we cannot ignore that the monetary phenomenon on oil prices, rate hikes and quantitative tightening certainly limit the rise in prices.